How you structure your income in retirement can play a major role in the taxes that you will pay. In today's video, I'm going to walk you through what income sources you'll have access to in retirement and how you can strategically plan your distributions in order to pay the lowest income taxes possible. Hi, I'm Adam Olson, a CFP with Mutual of Omaha, and I help clients retire with confidence. This video today will help you do just that. I'm going to show you how to structure your retirement income in the most tax efficient way possible. So before we get started in this video today, I want to walk you through what different types of retirement accounts that you're going to have at retirement. These are the three most common ones that you're going to see. The first most common type of retirement account is a tax-deferred account. This is like your traditional IRA or your 401k. So a tax-deferred account, money has went in before taxes have been taken out, and it grows tax-free, which is awesome. So you save on taxes going in and you get tax-free growth, but when you take distributions out of those tax-deferred accounts, the entire thing is taxable when you take it out. And then we have tax-free accounts. So number one was tax-deferred. Number two is a tax-free account. This is a thing like a Roth IRA or a Roth 401k or an index universal life policy. Now, tax-free accounts, money that went into these accounts has already had taxes paid on it. So it grows income tax-free. And then what's really powerful with tax-free accounts, you guessed it, you can take it out income tax-free at retirement time. So if you don't have tax-free accounts, you need to start beefing up those sooner than later. And the last type of account that you're going to have access to is just called a taxable account. So this could be like your checking and savings accounts. This could be brokerage accounts or individual accounts. So there's no pre or post-tax benefit when it goes in. It's just taxed on the growth every single year or when you do distributions out when you have to sell an appreciated asset. So you have the tax-deferred accounts, tax-free accounts, and then a taxable account. So those are the three most common types of retirement accounts that you're going to have access to. In addition to that, you're probably going to have other sources of income at retirement time, whether from Social Security, maybe a part-time job, maybe it's rental income from a building that you own or rental income from a rental property that you own, or maybe you're one of the lucky ones that has a good pension. So don't forget about the other income sources that you're going to have at retirement time too, because those are also, you guessed it, taxable to you at retirement time. Now, I want to walk you through how you can start funding paychecks in retirement. This is very important. When I work with clients on their retirement plan, I set you up with paychecks, whether it's once a month or twice a month, because you've had a paycheck your entire life. And when you enter retirement, you may be worried that you don't have a paycheck anymore. Well, when we work together, we structure payments once a month or twice a month to you in your bank account, so it's just like you're still getting a paycheck while you were still working. It makes life way easier for you when you know a paycheck's coming in the next 2 weeks, so you can safely spend some of the money that you've worked so hard for your entire life. Mentally, that's a big mindset shift that we use with clients. So now let's get into structure. How do we give you the structure that you need in order to get this income out? Well, let's use an example here. Let's say you need $100,000 of income. Well, first off, we need to figure out what your fixed income sources are. So think about, again, Social Security, pensions, and rental income. So let's say you need $100,000 and you have $40,000 from these different Social Security sources. Well, guess what? We have a $60,000 shortfall. Now, check out my video on safe distribution rates so you're making sure that you're not taking too much money out early on, because that might cause you to run out of money down the road. So check out that video. The shortfall is $60,000 in this video for this example, and then guess what? You have your $100,000. Now, what the difference is here is, where do we pull that $60,000 from, and how do we pull it out? Remember, when we start to pull out income from your investments, it can be a taxable transaction to you. You control this right now, and where you take the money from, the $60,000, that's going to affect the taxes that you pay at this time. So let's start with just giving you generally what most people do, whether you're working with a general financial advisor or whether you're working on your own investment strategy, on your own retirement plan. This is what most people do, and this is an okay method to be using. The typical recommendation is you take out of your tax deferred accounts first. So this would be like your IRAs and your 401ks. And then you hit up the taxable accounts, which is like your cash, your brokerage account, your joint accounts. And then lastly, you save the Roth accounts for the end. That's generally what most people do, because they're thinking, hey, you know, these tax deferred accounts, I have to take RMDs out at age 73. So in my mind, that makes the most sense that let's access those first. So, hey, we're going to take all of the taxable money out first. That's okay. But then the taxable accounts, maybe those are paying dividends to you every year. So let's just take those out too. But hey, the Roth money, That's income tax free. Let's save that for the very end. Generally, that's what most people do, is they save the Roth for the very end. Again, that's an okay way to do it. That's not a bad way to do it. But let's dig in a little bit more into how this could affect you if you did the okay route. And I do want to add too that I don't want you just to have an okay retirement. I want you to have an awesome retirement. And in order to do that, you have to be strategic with your distributions. Because if you would have just taken the $60,000 out from the tax deferred account, it would bump you into the 22% tax bracket. So let's jump into this now. I want to talk to you about a customized strategy. This is the best way for you to do distributions from your retirement accounts. It's going to change year over year, but a customized strategy allows you to take advantage of the accounts that you have to keep that income tax as low as possible. So again, this changes every year, and your income needs are probably going to change every year as well. So you need to examine the tax bracket each and every year and be strategic on where you're pulling money from. In addition to that, don't just look at this on a year-by-year basis on where you're pulling money from, because hopefully your retirement's going to be 20, 30 plus years longer. And so you need to match your investment strategy to your withdrawal strategy. Here's what I mean by that. If you have, say, you're just retiring at age 65, and you have an income need of $50,000 every year. Well, if you got $500,000 sitting in a bank account, you could access all of that money from the bank account. But let's say that bank account money that you invested in stocks. Well, it's not going to be efficient to pull all of the money out in your first 5 years from stocks, because that's an extremely risky investment to have money invested in. So you need to make sure that your withdrawal strategy matches your investment strategy. So the money that you're going to be spending right away in retirement, make sure that money's invested conservatively and not aggressively. So let's get into this customized strategy. I'm going to use the same example that I did before. You need $100,000 of income. And then we're going to find your taxable income right now. So this would be like your Social Security, your pensions, and your rental income. Now, the taxable income is different from your adjusted gross income. Your adjusted gross income minus the standardized or itemized deduction, whatever one you take. And so this example, let's just say it's $40,000. So let's call your taxable income $40,000. Now, grab the shortfall that you had, which is $60,000, and let's look at your tax bracket. Remember, right now, you are in control of the taxes that you pay on these distributions. Now, in 2024, say you're married filing jointly, the 22% tax bracket starts at $94,300. That tax bracket jumps from 12% all the way up to 22% at $94,300. So, if you were to take all of that shortfall of $60,000 from your IRA, just like most people would do in that first year, you would end up in the 22% tax bracket. That is a huge tax jump of 10%. From 12 to 22, that is a huge tax jump just because you pulled it all from the taxable bucket. That's in what most people would do in this situation. But the better option, how about we think about this? We only take $50,000 from the tax deferred bucket from the IRA account. You only take out $50,000. So that gets us to $90,000 worth of taxable income. Well, guess what? That 22% bracket doesn't start till $94,300, right? So we got a little bit of wiggle room, and we only needed an extra $10,000 of income to get to our goal. Well, at that point in time, we could access the Roth for tax-free income, or we could access some cash in the bank account, or maybe cash in a brokerage account to get to that $100,000 income need. That just kept you in the 12% bracket with all of the income over that dollars, which is a huge change for you. So you need to pay attention each and every year what your income need is, and make sure that you're filling up that income tax bracket. So in this specific situation, maybe we take a little bit more out of the IRA to really get up to that $94,300, but then the rest we're taking from accounts that we're not going to get hit on taxes from, so you don't get into that 22% tax bracket. And I also got to add here, guys, this is very important. Each and every year you have to pay attention to what the IRMAA penalties are. Remember, once you get on Medicare age 65 plus, your Medicare premiums are based upon your income each and every year. So pay careful attention to what those income brackets are, and make sure you're keeping your income below those certain thresholds. So let me just do a recap of this. Your income needs are probably going to change every year, and they will change, and the taxes change as well. So make sure that you're paying attention to your distribution strategy each and every year and matching it up to those tax brackets that you have. And you need to have a long-term outlook. I've seen people do this before too. they've cashed out all of their Roth accounts in their first 3 or 5 years of retirement because they say, hey, it's tax-free money. Why don't we take advantage of this tax-free money that we have from the Roth accounts? Well, that's good and great, but you just shot yourself in the foot those first couple years of retirement, because now in the next 20 years, you have access to no tax-free dollars whatsoever. So you need to have a long-term outlook. What's an appropriate amount for us to take each and every year from the 3 different types of retirement buckets that we have? Tax-deferred, tax-free, and taxable. And then also you need to match your investment strategy, the withdrawal strategy that you have, match it with the investment strategy. So we have withdrawal strategy over here and investment strategy. So if we're not going to touch our Roth money till the very end, say with our strategy, we're not going to need the Roth money for 20 plus years, then it can be aggressive. But if we're going to need to access some of those Roths in the first 5 years, you better have some of that conservative so you don't lose money when the markets downturn. In addition to that, required minimum distributions start at age 73 for all of your tax-deferred accounts. So don't forget to take that into calculation when you're looking at turning on distributions at 60 or 65, because if you wait to take out all of the tax-deferred money until you're 73, you may have a big old required minimum distribution that's really going to bump up your tax rates. And for those people that are charitably inclined, don't forget that you can start doing a qualified charitable distribution at age 70 and a half. That's where you take money from your tax-deferred IRA or 401k, and you can send it to a church or charity of your choice with no taxes due on that money. And I also have to add that your Social Security is taxable at different levels each and every year. It can be taxed at 0%, 50%, or 85% of your Social Security benefit can be taxable. So never is 100% of your Social Security benefit taxable, but if you get your income below certain thresholds, provisional income, there's a separate video that I have on that you can watch at a later date, but if you get your provisional income below certain thresholds, you may get tax-free income from your Social Security benefit as well. There are some special considerations that you'll have to take into effect if you're doing the withdrawal strategy on your own, such as healthcare costs and long-term care expenses as well. In addition to that, there can always be tax law changes and regulation changes. And again, everybody's personal preferences are different and your goals are different. So everybody should have a different and unique strategy each and every year. Now, why would you work with a financial advisor? Well, one of the reasons why, consulting with a financial advisor, he or she will give you a personalized withdrawal strategy. But you need to make sure that that advisor has a good understanding of state and federal taxes, taxes on Social Security, other things like homestead exemptions that you may qualify for in your state. And of course, don't forget, make sure you have an IRMA certified planner as well, so they understand the cost of IRMA on your Medicare premiums for future years. I hope you guys enjoyed this guide today that I walked you through on how to create a customized withdrawal strategy in retirement. Let's do a quick recap here again for you. You have tax-deferred accounts, tax-free accounts, and taxable accounts. Each and every year, you're probably going to want to access some of those 3 different accounts to keep your income taxes as low as possible. And remember, try to fill up that tax bracket if it works for you in your situation. Now, if you enjoyed this video and you want to book a call with me, my meeting link is in the notes of this episode. Feel free to grab in there, grab a time for us to meet. I'd love to connect with you and help you create an ideal retirement plan for yourself. Look forward to seeing you on the next episode, and thanks for listening to the Money Master Unleashed podcast. I'm your host, Adam Olson. This podcast is for educational purposes only and may include references to concepts that have legal and or tax implications. It's not to be construed as legal or tax advice. Such information or opinions is subject to change without notice and is not intended to use as an offer or solicitation with respect to the purchase or sale of any security, insurance products, or offer of individual investment advice. Any strategies discussed may not be suitable for everyone. Mutual of Omaha Investor Services, Inc. does not provide legal or tax advice. Please consult with your appropriate professional regarding your personal situation prior to making any financial decisions. Securities and advisory services offered through Mutual of Omaha Investor Services, Inc., member FINRA SIPC. Riser Insurance is not affiliated with Mutual of Omaha Investor Services. Investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. Diversification does not guarantee a profit or protection lost against loss in a declining market. Purchase of life insurance is subject to meeting underwriting requirements. There is no guarantee of an individual will be insured. Annuities are long-term investments designed for retirement purposes. Withdrawals of taxable amounts are subject to income tax, and if taken prior to 59 and a half, a 10% federal penalty tax may apply. Guarantees are backed by the claims paying ability of the issuer and are subject to their terms and conditions.